Hello traders, Igor here from MrTopTick.com. Welcome back to the channel. If this is your first time tuning in, consider subscribing to the channel. If you enjoyed today's content, please feel free to share it and make sure to leave a like. Today we're going to look at one of the trades that we just recently did. It actually is rolling off today. This is a variation of a 1-1-2 bear trap. For those that are in our Income Navigator Discord, you can go and look at a trade ID 2695, and you can follow along with all the steps that were taken, with all the notes that I left, highlighting my thought process, what I was looking at and what I was thinking. I'm going to try to consolidate all of that into a short video, hopefully, and give you some insight as to what I look at when I take these kind of positions and what my thought process as I go through each and every single step in this trade. So this trade was initiated back on June 29th. Instead of doing a typical 1-1-2, I decided to go with a slightly different structure. This was a 1-1-1. So instead of selling 2 out of the money puts naked, I only sold 1. I took less credit up front. And the reason why I did that was because, we just had a pretty decent expansion from May up until mid-June. We had a very tiny pullback, and now we're back above 8 and 21, above 50-day moving average. So we're still bullish, but I am looking for some sort of a pullback. And that's why I took less credit up front. My position, as you can see, my deltas started off with about -11 instead of a typical 1-1-2 will start off with a decent positive delta. So here I started with slightly negative delta. I structured the trade as a 1 put debit spread that was covered as far as cost goes. It was covered by a sale of farther out of the money put naked. Now, before we go any further, I do want to put something out there. Trading SPX options does take up quite a bit of margin. These kind of trades are very friendly in the portfolio margin accounts. But even then, we all need to be aware of the risks that are associated with these kind of trades. We do have naked options here, and as we all know, we potentially have an unlimited downside risk. So we do need to be aware of that and always have some sort of portfolio hedges for the event that may be unforeseen at first. But if we do black swan down 20%, instead of eating a massive loss, we need to have a portfolio hedge on. We're not going to go into portfolio hedges in this video. We are going to look at this position, and I'm going to take you through every step of the way to show you what I did, when I did it, and I'm going to try to share my thoughts as to why I was doing what I was doing. So this trade was initiated with 63 days until expiration. I wanted to set up my trade in a way that I will have my short out of the money put cover the cost of my put debit spread. I put this trade on for a net credit. This position was a 20 contract position, so I collected a $1,200 credit up front. From here, I have several outcomes. If the market continues to move higher and I do nothing else to this trade, I will end up keeping the $1,200 that I collected up front. If the market goes up and down, and then eventually over the next 63 days, we are somewhere inside of the bear trap, which is between my put debit spread and my short naked puts. This is where my put debit spread is going to be worth its max value. I put on a 50-point wide put debit spread. So this put debit spread could be worth 50 points or $5,000 per one contract. And my short out of the money put is going to expire worthless. So I'm going to make the 50 points from the put debit spread plus the small credit that I collect up front. And that is what we call the bear trap profit. Now, my thinking here is pretty simple, that if the market continues to run, I don't really have any upside risk here, right? Since I took a credit up front. Worst case scenario, if it runs away, I do nothing else, I'll keep the credit. But I am thinking that as the market continues to move higher, obviously I can't move the price. What I can do is I can manipulate or do several adjustments along the way as the market moves higher to move my trap a little bit closer towards the price. And then eventually I should, if we get some sort of reversion, I should be positioned in a way where my bear traps are not too far away from the price to come back inside the trap, hopefully very close to expiration. And that is where we're going to capture majority of the profit in this trade. So this was the initial setup. We're going to go to the following adjustment, and the following adjustment was on June 30th, which is the following day. So this is June 30th. I made an adjustment. What I did was, so this is what the trade looked like. So we're 1 day in the trade. S&P 500 moved from entry about 2.3 standard deviations to the upside. As I said, the market is looking very bullish here, which is totally fine since we don't have any upside risk. What I decided to do as the price continues to move away from the bear trap, I'm going to add several other tranches, and hopefully I'll position myself so that I can capture price somewhere inside the trap, somewhere around expiration. So this was what this position looked like before I added another 112. So I added a 112 structure a little bit closer to where the price was on June 30th. I had collected another 30-cent credit. This was a 20 contract position, and now I have two 112s going, and my total credit that I have collected so far is $1,800. From here, just like I said before, I have several potential outcomes. If market continues to run higher, I will just get to keep whatever credits I have collected so far. If the price reverts back inside the trap, I have put debit spreads that are going to increase in value drastically. As long as we don't move too far into the trap early on, this trade is really low maintenance. There's not a lot to worry about. The only thing we need to worry about is if we move halfway into the trap in the next week or so, we need to figure out if the market is really turning on us, and we need to figure out how to deal with this T+0 line that's pointing lower. And as we move lower in the price of S&P 500, this trade could potentially turn into a really nasty winner. So that's really the only risk in this trade, is on the downside. Now from here, my plan is, if the price continues to go higher, I'm going to, again, either take my initial 111 and roll it up higher, or I'm going to add another 111 or maybe 112. I'm going to add another structure a little bit closer to the price, and that is going to continue to move my trap higher along with the price of S&P 500. So we're going to go to the following adjustment, which was on July 3rd. So this is Wednesday, July 5th, and this is what the position looks like. What I did was, as the market continues to move higher, I added another 111 structure. So now I have three. They're all 20 contracts each. So now I have a put debit spread from the most recent, the third layer that I put on. I have another put debit spread. This is from the second layer that I put on, and this is my original put debit spread that I put on. And then I have 3 layers of out of the money naked puts. I have the original naked put at 37.50. I have another short put at 38.50, and then I have the most recent short put, which is right at 39. Let's see, this one is at 39.85. So now I have 3 layers on the price. As we can see, in 6 days from the original entry, S&P moved just under a 1 standard deviation. So market is not doing anything that wasn't already being priced in. However, if we look at the price chart, we are above 8 and 21 EMAs. We're above 50-day moving average. Everything is stacked bullish. There's really no reason why we should think that the market is going to crash from here. Now, having 3 layers on, my thinking here is pretty simple, very similar to what I thought before. If the market continues to run with 3 layers on, I have collected a net $3,000 in total credits. So if the market runs away from me and I do nothing else from here, worst case, I get to keep $3,000 credit that I collected. If we pull back into the trap, these put debit spreads are going to increase in value, and presumably implied volatility isn't going to explode. My short naked puts that are now pretty far out of the money should also lose some of its value, and this trade should show a really nice green P&L. We can also look at projected T+0 lines. We can see that, let's look at the red line, right? The red line here is T+19. So this trade on July 5th, this trade had 57 days until expiration. If we go 19 days into the future, right, at 38 days to go, if we are still where we are at this time, S&P was at about 44.50. Obviously, naked puts are going to decay. I don't think that the put debit spreads were going to lose a whole lot of value, and that's why we're seeing this nice hump being built. And the T+19 is the red line, is indicating that if we're somewhere around 44.50 in 19 days, we should have a pretty profitable position. And if we're pulling into the trap area, this position should also be profitable, but the profits should start to increase because now put debit spreads that we're building, they are now increasing in price, and the software is assuming that as we pull in towards 43.50, 19 days from July 5th, implied volatility is not increasing drastically, so the puts that are short are decaying, the put debit spreads that we have on are increasing in value, so both sides of this trade are working in our favor. The reality is it doesn't always work that way. If we were to move in 19 days down about 3.5%, I do think that this red line was going to be lower, assuming that implied volatility was going to increase a little bit. But this is what the software is projecting. And from here, again, my thoughts going forward, if we move higher, I could do nothing and just plan on keeping the total credits that I had collected. Or I can try to manipulate this trade in a way that will move my trap a little bit closer towards the price. And I always have to worry about the downside risk. If we move halfway into the trap inside of the following week, something is wrong. I need to pay attention. I need to figure out how to hedge off some of that risk, because as we can see at this point, right, S&P in 6 days moved about a 1 standard deviation to the upside. This position is negative delta, so a little down action is not really hurtful. But if we move down towards 4,200 in a week, my slight negative delta at 4,200 is going to turn into a pretty big positive delta, right? So I go from minus 28 delta to about plus 473. So I have a lot of delta risk at this point. Now we're going to go to the following adjustment. So we go from early July. The next adjustment was at the end of July. So for almost a month, we did nothing in this trade. And I'm going to show you exactly what this trade looked like at the next adjustment, which was July 27th. So this is July 27th. We are in the trade for 28 days. From the time when I took this trade, S&P has moved 1.62 standard deviation. So we are moving slightly above than what the market was pricing in when we took the trade. And We can look at a price chart here. Again, very bullish action. So when I took the trade, I thought that we might go up a little and come back down. We didn't do that. We continue on to marching higher, 8 and 21 stacked above 50. We are running away to the upside. And here is what this position looks like before making any adjustments. So you can see that, I've built the bear trap. I added the second layer. I added the third layer to move my trap closer to the price. Yet the price continues to run away from me, which is really not a big deal. Again, if the price runs away to the upside and I do nothing else, we'll end up with a small profit. We are playing this game in a way we are trying to do what we can with reasonable amount of risk to move the trap in a way that the price is, and that's if and when the price reverts back to the mean. We need the trap to be somewhere around the price that the price could enter the trap and our put debit spreads could engage and give us a really profit that we're going after. So this is what this trade looks like 28 days from entry. We are now trading at 45.90 on the S&P 500, and I made an adjustment here, just looking over the notes on our Discord channel. So what I did was I consolidated my short out of the money puts. We can go back and look at what this trade looked like before making the adjustments. So I have 3 layers of naked out of the money puts that are short. I took the initial naked put, which is at 37.50. I took my second layer naked put, which is at 38.50. I bought these to close, and then I sold to open 2 layers at my third naked put, which is the highest naked put to the price, at 39.85. So I closed 20. I closed 20 and I sold to open 40. So now I have 60 naked puts at 39.85, and then I have the original 3 layers of the put debit spread. And this is what this trade looked like. I collected a credit for the roll of my original 2 layers to my third layer, and now I have collected a net total of $6,800. And my potential outcomes here as follows. If the market continues higher, I get to keep the $6,800. If the market continues to trade sideways from here, it's still not really good enough for this trade, because in order for this trade to really pay off, we need the price to come back somewhere inside the trap. And we can see that even at this point, 28 days in the trade, we have 35 days to go. So we're kind of halfway there. My trap is still almost 4% out of the money from where we are on the S&P 500. So if we look at, this trap really starts at 4,400. We can look at the chart, right? Where do we need to go in order to get to the trap? So from almost 4,600 down to 4,400, right? We have 200 points. From 4,600, we need like a 4% pullback in order to get to the trap. So I don't want to say it's unlikely at that point, but the probabilities are not great that we're going to see a 5% pullback into the trap. So now my thinking is I need to figure out a way that I can safely move the body of this trade closer to the price without moving it too close in the event that we do get a pullback and I could potentially run into trouble. Because keep in mind that, while my T+0 line is relatively flat, right, where we are at that point in time in this trade, my downside risk remains, right, somewhere at around 4,100 is really where my T+0 line starts to escalate to the downside. So I don't want to over adjust, meaning I don't want to move my trap too close to the price where a small 5% pullback is going to put me in a bad position. So I want to keep my trades far away from price, yet I need to figure out a way how to potentially increase my reward if the price is going to stay outside of my bear trap, which is made up of 3 layers. So we're going to go to the next adjustment, which was on August 8th. So here we are. This is Tuesday, August 8th. And this is what this trade looked like before I made the adjustment. And the adjustment was, I wrote to our members that I am going to sell to close 4250, 4200 put spread, and I was collecting $2.60 credit. So what I ended up doing, 4250, 4200 is not my, so 4250, 4250, 4200 is the third, or this is the original put debit spread that I put on. So I was going to remove the original put debit spread, right? Because in order for this put debit spread to pay, the price has to be inside this put debit spread, which means that S&P has to go from 44.93 down to somewhere below 4,200. I don't think the odds are great, right, to see a 6% pullback at this point. The market was just too strong for this. Even though we did come down some, right, I don't think the market is going to roll over and die here. So what I did was I decided to go ahead and close out my farthest put debit spread. I collected $2.60 credit, right? If you notice here, every single thing that I did so far in this trade resulted in a credit. So I continue to increase the credit that I collect, which means that if the price eventually ends up somewhere above the structure or outside of my bear trap, the original small credit that I started with, every adjustment that I did along the way has increased in the amount. And now, before making this adjustment, I was at $6,800 credit. And then when I closed out my 4,250, 4,200 put debit spread, I collected a credit, and now I ended up with a total credit of $12,000. So I doubled my potential reward if the price was to expire outside of my bear trap. So this is 40 days in the trade. We have 23 days to go. Now this, in the last 23 or 25 or 21 days, things are starting to get a little dangerous, if you will, because if we start to pull back into the trap, which at this point still looks totally fine, but if we start to push below 4,300, you see my T+0 line is going to start to really dive here. So I have to be aware of that risk. And in the last couple of weeks of the trade, this T+0 line is going to get more and more pronounced, and it's going to get a lot more steep on the downside. So losses could come really, really fast. And that's why we need to always keep that in mind and have an idea of what we're going to do if the price was going to come back into the trap pretty fast and pretty hard. We can talk about potential adjustments here, but I really want to stay focused on this specific trade here. So from here, we go to the next adjustment that was done on August 10th. So we go forward just 2 more days. And this is what the trade looked like before the adjustment. We could look at a price chart real quick. So, from where we came, right, which is around 4,600, I said, I don't think we're going to pull into, towards 4,400. Boy, was I wrong. But as we can see, I could be wrong, and this trade is still making money because I think adjustments that we're making are not only increasing total dollars as far as credits go that we collect, but our risk is also still far enough away where we're not facing big trouble. And what I decided to do on the 10th was to close out half of the 4,400, 4,350 put debit spread. So 4,350, 4,400 was my 4,350 was my the second layer. So what I did was I closed out half. I collected $10.50 credit, and this is what the position looked like. I increased my potential reward if we were to expire outside of the trap. So you can see that my credits here went from 12,000 to 22,300. So I collected a credit. Now we can also look at my exposure as the market is pulling in. Right here, I had minus 91 delta. By closing out a part of my put debit spread, I was also removing some of that short delta, turning this trade more or less delta neutral. So from here, my T plus 0 is pretty flat. And the next couple of days or maybe a next week will kind of dictate as to what I'm going to do next. I know that, again, from here I have a couple of potential outcomes. If the market turns around, right, maybe we test a 50-day and then we bounce. If that happens, well, worst case, I get to collect all of what I had collected as far as credits so far. If we continue to pull in towards the trap, it's a good thing because we can look at projected lines. So that red line now is T plus 7, which is only a week from August 10th. So if we pull in inside the trap in 7 days, the P&L in this trade is going to obviously increase pretty drastically. So it's a positive thing. The only thing that is going to hurt this trade is if implied volatility expands. And we can see that if we just move, let's go forward 7 days, right? So we can see that this is my T plus 0, 7 days from August 10th. So at around 40, let's just look at 4,300, for example, right? So in 7 days, if 4,300 hits, we can see that P&L is showing a profit of about $50,000, which is great. And that's assuming that implied volatility does not change. But if we go forward 7 days and we're still looking at price level 4,300 on the S&P, if we just take volatility up 10 points, right? So if we pull back down from 4,465 to 4,300 in 7 days and volatility moves up 10 points, right? It's like VIX going from 15 to 25. At 4,300, instead of being up 50,000, this trade is going to be down 35,000. So that's a pretty big P&L swing, right? So volatility matters here. Short gamma matters, and short gamma is going to push our delta. So we do need to be aware of that and be prepared to make adjustments if necessary, even though the software thinks that if we were to pull back towards 4,300 and we don't expect any drastic changes in implied volatility, this position is going to show a really nice P&L. That is not necessarily correct. So we're going to go forward. This is August 10th. We can go forward to August 15th. So this is 5 days later. And 5 days later, my adjustment was to close 15 out of 20 of the 43.25, 42.75 put debit spreads. I collected $6.65, I believe. And what that, so this is what my position looked like before making the adjustment. Right, as you can see that T plus 0 line is rising above my graph at expiration because the short puts that I'm holding are decaying. And as the price continues, you can see that on this day, on August 15th, we moved 1.75 standard deviations, which is outside of expected range for that day. S&P was down 55 points. And what's happening here is that as we move towards these put debit spreads with 16 days until expiration, these put debit spreads are starting to increase in value, while the short out of the money puts are not really taking on a ton of heat with this move lower, because you can see that they're about 10% out of the money with about 2 weeks to go. So not really scary for the short puts, but definitely very good. It's a very positive thing when the market moves like this in the last couple of weeks, with put debit spreads being this close, right? We're down about 1.2% on that day, and we have the put debit spreads about 2 or 4% out of the money. So probability of these puts going in the money is increasing, while probability of the short out of the money naked puts going in the money is really not increasing by a whole lot. So from here, we can see that while this risk graph looks really good, we still have to worry about a big down move and a potential expansion in implied volatility. So that is always on my mind. But I'm also thinking that if we continue to move inside of the bear trap, as my deltas go from negative to positive, I need to figure out how to keep my delta or my directional exposure relatively flat, right? So that I could balance the price somewhere inside the trap and hopefully burn off about 2 weeks worth of time, so that we can maybe capture price somewhere inside of these put debit spreads and the short naked out of the money puts. I don't think I had a whole lot planned, so I'm just going to read notes that I wrote. So I said this trade has 16 days to go. I realized that I'm giving up some of the potential profit inside the trap at expiration, but I'm also increasing potential profit if we do not hit the trap by expiration. So by closing out, right, this is what my trade looked like before I made the adjustment. By closing out 15 out of 20 of the put debit spreads, I am shrinking the size of the trap, so I'm reducing my potential reward inside the trap in exchange for a slightly higher profit if the price was to bounce hard and run away from the trap. So there are always two sides, right? There's a positive and there's a negative. So what's the positive? The positive is I am increasing my potential reward outside the trap, and the negative is I am decreasing my potential reward inside the trap. And we can see that before making this adjustment, my delta here was minus 130. After I made that adjustment, my delta went to minus 20. So again, I reduced the size of the trap, I increased my potential reward outside the trap, and I also cut my net directional exposure from being down or being negative 130 S&P delta down to only about 20. So that's a positive, at least for me. The following adjustment was on August 16th, the following day. And the adjustment was, I wrote, I'm going to sell to close the remaining 5 of the 43.25, 42.75 put debit spreads. I'm collecting $6.70. My remaining position, and this is what it looks like. This is what it looked like before. And I am closing the remaining 5 of these 43.25, 42.75. My net delta is minus 46. When I make the adjustment, my delta goes to only minus 8. So again, I am neutralizing my directional exposure here. I'm collecting a credit, which means I am increasing my potential reward if we never hit the trap at expiration. But I am giving up potential trap profit, and I'm fine with that. So this trade has 15 days until expiration. From here, we have a couple of outcomes. If we remain above the trap, I'd collected $35,700 in credits. If we do hit the trap, I will make the, I have a 4,400, 4,350. So this is a 50-point wide. So I have about 50 points worth of potential reward if we hit the trap times 10 contracts. So that's an additional $50,000 in potential profit inside the trap. And obviously, if we completely roll over and die, this trade still could potentially run into big trouble. But at this point, we would need to see S&P move in excess of 5 or 6% in 2 weeks. And this is already after we have corrected almost about 5% from the highs that we made on July 27th. All right, so this is 15 days until expiration. We go to the following adjustment, which is on August 22nd. So on August 22nd, I wrote, I'm going to sell to close 5 of the 10 remaining 4,400, 43.50 put debit spreads. I collected $16.80. So now what I'm doing here, remember I had 10 of the 4,400, 43.50. I closed 5 of the 10, so I closed out half of my put debit spreads. Again, what am I doing here? I am giving up my potential profit inside the trap. Credit I am collecting. I am going to increase my potential reward if the price was going to run back up and away from the bear trap. So we can see that before making this adjustment, my net delta was minus 97, and my total credits that I'd collected so far was 35,700. And after making this adjustment, my net delta goes to minus 6. So my position, once again, relatively flat. And my total credit in this trade goes up to $44,100. This is with 9 days until expiration. And we could, look at this remaining position with 9 days. We can see that even at current implied volatility levels, and we can see that I think vol was at about 15. So the market is really not pricing in a whole lot, but we can see that this darker shaded area here is the one standard deviation move based on implied volatility at that time, which was August 22nd. Expected move here is we are expected to stay inside of this range, which is up to 4,500 or down to about 4290 or so. So if we are inside the expected range, either we're going to expire outside of the trap or inside of the trap. So the inside of the trap now becomes a bonus. I have 5 contracts. They're 50 points wide. So there's about an additional $25,000 to be made if we were to pull in and expire inside the trap. And if we were to go up and away from the bear trap, this trade will only make $44,100. The following move was on, so now we're at August 22nd. We go 2 days forward to August 24th. On August 24th, I wrote that I'm going to sell to close 3 of the remaining 5 of the 4,400, 43.50 put debit spreads. I am collecting $20.50. And this was on a day where S&P moved minus 1.8 standard deviation. So we're moving aggressively towards the trap, right? One would think, why in the hell are you closing? But we can look at what this trade looked like before. And even with this move, right, minus 1.8 standard deviations to the downside on that day, I'm still minus 59 delta for the S&P. Closing out 3 of 5 of these put debit spreads, collecting $20.50. So I increase my potential reward outside the trap. See, I continue to think about price going back outside the trap. While I do need or want the price to be inside the trap, I also don't want to just sit on my hands and do nothing in the event that the price runs back up and away from the trap. And again, this is only because we had already corrected about 6%, right? Are we going to roll over and die here? Well, if that happens, my trap profit is going to be smaller, and I'm fine with it. But if we were to bounce after this pullback, right, the odds of us bouncing from here, even though now we can look at moving averages and say, well, hold on a second, something is changing in the markets. We're below 50-day. 8 and 21 have crossed bearish back on August 10th. So is this the start of a new trend? Maybe, but I only have 7 days here. So the trend really doesn't matter to me at this point, right? So what I ended up doing is I closed 3 of the 5 of the remaining put debit spreads, and that left me with 2 put debit spreads and 60 short 39.85s, which were about 10% out of the money or so, with 7 days to go. So not too scary, but if we black swan here, this could turn ugly quick. If we don't black swan and just do a normal pullback, then we have some more potential upside inside the trap, which is great. Worst case, if we bounce and run higher, this trade had collected $50,250 in total credits. We can look at expected range for the next 7 days, right? We either going to go up towards 44.60 or down towards 42.90. Either of the outcomes are fine. So I'm just going to hold from here, and that is the last adjustment that was made for this trade. Now today, August 31st, S&P 500 is currently trading at around, where are we on the S&P? We are at 45.20, so we can go to today. This trade was marked as closed, even though the contracts are going to expire today at 4 o'clock, but you can see that at 45.20, right, the remaining 2 put debit spreads are going to be worth 0 at 4 o'clock. And the short 60 of the 39.85s are going to be worth 0 at 4 o'clock. So all in all, we get to keep the $50,250 that we had collected all throughout this trade by making incremental adjustments as the price was running up from where we started this trade. We were at 43.96. We ran up to about 4,600. We came back down just below 4,400, and now we're bouncing back above 4,500. So that's it for this trade. It's going to expire today at 4 o'clock. This trade is going to make a profit of $50,250. If you enjoyed this content, please like this video, subscribe to the channel, share this video with somebody that you think could find this information useful. I hope that you learned something new, or you were able to pick up something that you may use in your own trading going forward. As always, if you take care of the risk, the profits will take care of themselves, and we are going to talk to you in the next video.